This is Stephen Gibson. I'm the chairman of the Affinity Wealth Management Investment Committee. This presentation presents the highlights from a market update meeting held in Wilmington, Delaware on March 27, 2018. This presentation shares the economic backdrop that we think is impacting the markets. We want to remind you upfront that we don't make specific investments simply based on an economic number. We look for other market indicators and technical patterns to confirm what we think is happening. And tonight we'll look at fundamentals, but we'll also visit whether the pricing patterns in the markets confirm what we think is happening. In short, we don't always see the markets doing what economists think they should. Our hope in presenting this is that it makes you more comfortable when things get rocky, because we expect a much more volatile year than the low volatile year we saw last year. And we think you got to stay the course when things look rocky, because that's a key to long-term investment success. This shock trader, though, on the initial slide, is a reminder that we understand that we're seeing political, economic, and other events that we've never seen before, but that does not mean they will be reflected in the prices and markets. The information we're going to give you is for general informational purposes. It's not your individualized investment recommendation. You should sit down with your advisor to make sure investments are suitable for you. In any investment review, make sure to consider the risk, because any investment can lose money in certain situations. So most of all, make sure you consider the risk before you make investment decisions. One of our themes for the night came from a cartoon that I watched as a kid growing up in North Carolina, and that was the Mr. Peabody and Poindexter cartoon that had a quick Wayback Machine. Now, if you remember this is from the 1950s and 1960s, so if you remember it, you're probably getting a little older like me. But we're going to use the Wayback Machine concept to go back, because many of you are new to Affinity, or you may be seeing this and are not an Affinity client. This will bring you up to date on some of the themes we've been discussing over our last market update meetings. And we'd like to also go back and see if the markets really confirm what we have been saying would be happening. And of course, one of the reasons we want to revisit it is over the last couple of years, our view that inflation would be muted, rates would be low, and stocks would move higher has proven to be correct. So we think there are three major drivers of the market results that we're seeing, and those are the Federal Reserve Bank and really central banks all over the world, who have really put about $18 trillion into stimulating the economy. And we also think that one of the reasons that hasn't worked to create rapid growth in the economy has to do with demographics, another important consideration. And also we think there's an amazing technology driver that is really causing a lot of productivity and profitability that normal economic measurement is not picking up. So let's talk about the first of those, which is the central banks around the world in 2009, and then continuing with the Europeans joining in 2012 or so. Around the world, $18 trillion has been put into economies to stimulate economic activity, and yet up until the last year or so, we've only seen, growth patterns of like 2%, and in Europe and others, they've had even slower growth. So when you stimulate the economy, you're supposed to have certain things happen. The way this works is the Federal Reserve buys bonds, and that lowers interest rates, and they give credits, low-cost credits at very low rates to the banks. The banks can then use those credits to lend money, and that lowers interest rates and stimulates the economy. So we would expect to see in that case an up stock market, and that happened. And we would expect to see stock buybacks, but we've seen incredible stock buybacks. In fact, in the last decade, about 25% of all the stock in U.S. public markets has disappeared or gone private. When you have stock bought back, it reduces the shares. Therefore, the earnings for each remaining share go up. It's just division. And many executives are incentivized. Their bonuses depend on getting earnings per share higher. Well, if you buy back stock, that gets to be a lot easier. So we've seen amazing stock buybacks. That's been a big part of why we knew that stock markets would likely go higher, and that's what happened. We also expect, and it's happened, that companies would have better margins and more profits because one of their big costs is interest rates, and interest rates are lower, so their margins are better. They're more profitable. And we also thought that stock yields would rise. As you have less shares, you're getting more income per share. That's how the company distributes part of its profits. And we thought that yields would get as high as bonds, and they have, and so that's affected markets the way we expect. And as we expected, you got really low rates, in fact, down to a 10-year treasury of 1.76 in 2016, which is the lowest interest rate for 10 years since the Revolutionary War. So that's all the things that we might expect when you put that much money into the economies. What we did not expect really was that we would have slow growth. All we've really seen is 2% kind of growth. Europe even less. Finally, we're starting to see some growth this year, which is a change. But we have not seen the roaring growth, and therefore we have not seen inflation. And without inflation, the Federal Reserve does not try to get rates to go back up. Now, finally, we're seeing just a small bit of inflation, but still relatively low at about 2%. So we haven't seen inflation. So what causes that kind? And one of the causes we think is pretty clear, and that is demographics. What could explain worldwide why there's not that much growth in economic activity and spending? Well, one of the things that could explain it is that all the major economies around the world are getting older. As this chart shows, you can see that we've got, in 2018, we've got about 50 million or so seniors, and we're going to get about 60 million as we get into 2020, 2021, and we're going to peak in 2040, 2050. We're going to be up in the 80 to 90 million people 65 or older, and an enormous part of the population in their 80s and 90s. So if you go to Japan and Europe, we can see what effects this have because they have even a more serious problem. In the US, we have about 10,000 baby boomers a day retiring. Those numbers are even bigger when you go to Japan and Europe. One of the reasons this is important is that seniors, they don't start houses and buy cribs, and they may buy the occasional toy, but they're not in the toy store every week. So they're not big spenders. They're actually more thrifty as they get older. And they downsize their housing, which means they need less furniture and other merchandise. And so the retail spending is transformed, and there's slower spending in the economy, and they tend to pay off debt. So basically, seniors and an aging population is deflationary, and that tends to help keep inflation down and interest rates down. One of the more difficult drivers for the economy, I just took a look at the notes from Powell, who is the new head of the Federal Reserve, and he made the same comment that Janet Yellen was making, which is that we at the Fed may not completely understand what's affecting inflation because inflation has not been hitting the targets that they have expected for 2018. I think the other factor behind that is that we have got an amazing technological transformation going on. We've got computers that are basically allowing small companies to use cloud computing and to use new technologies that make small businesses amazingly able to compete by using applications from a central server. And that's one reason you see us investing in small cap stocks quite frequently. Even at Affinity, we're able to access the investment tools that really a $1 trillion manager would have had, 5 years ago. And that's because of the new power of placing big computing power in remote sites and accessing it with mobile pads, mobile phones. And so computers have gone mobile and they've gone to a cloud model. So cloud computing companies are exploding. And that means you can do a lot more work with fewer people. That's a lot of productivity, and it's difficult for economists to measure that. It's also having another effect, which is certain parts of the market are exploding in profits. Companies in cloud computing, artificial intelligence, and particularly semiconductor chips. That's the actual brains of the computer. And many of those brains are about the size of a thumbnail or even smaller. And they're actually being engineered at the atomic level so that the smallest, tiniest computer chip or sensor is now able to do amazing amounts of work. In the old days, they used to have one layer of processor on that thin chip. Now they've gone vertical, and so we get complex semiconductor chips that we call them. That industry is exploding. One of the most profitable type of company we've seen in the markets over the last 30 years. And that's allowing artificial intelligence to come forward, which is somewhat like a thinking, sensing computer. And you're seeing this all around you. It's certainly in your phone. It allows us to have self-driving cars. It really makes your refrigerator smart, or a drone can follow you around. It's transforming the whole landscape of not only business, but your home or your mobile phone as well. But if you turn on the news every day, you get a battle of opposing forces. And what we really want to know is what forces are shaping the markets so we can make an estimate of what pricing will look like over the year. But day to day, when you get news and information, you get information that, oh, today there are tariffs, or maybe the euro market is negotiating Britain exiting, or maybe Korea is threatening today. And so you get one good piece of news and it pushes you up. You get another good piece of news and it pushes you down, just like this machine. At our presentation, someone actually knew the name of this. It's a type of momentum machine. I found it by looking for clacky balls, which gives you a very interesting response if you go on Google. But the point it's making is that the central part of the economy does not move because of these day-to-day worries and events. It really moves based on fundamental long-term economic drivers. But those drivers are not clear cut. Like we said, the Federal Reserve is trying to raise rates. They're talking about as many as 3 more rate increases this year. But rates, despite them trying to raise short-term rates, 10-year rates have only moved up from 2.3 to 2.8. It looked like they were going to go above 3, and we thought for the year that we're probably not going to get much above 3. But when they got to 2.9, they stopped and actually have moved back down. There's a possibility, if inflation stays as low as it has been for the reasons we just mentioned, that we could see rates actually move down. That would be very good for bonds. So far this year, bonds have been down a little bit because we did see a little bit of movement in rates, and that's because we saw a tiny bit of inflation. But inflation hasn't actually moved that much. It's not at or above the 2% that is really what the Federal Reserve would like to see. So far, our bet that inflation is not going to be quite as strong as expected is proving correct. But that's what the market's uncertain about. Some people in the market think the inflation is going up, so they're acting defensively. Other people, not so much. The stock market's strong, but we're down about 7% from the highs in the market last year. And the reason we made highs was we had record profit. Record profits mean we should have record levels in the stock market. So the point is the stock market is not in a bubble right now. Wages, which is one thing the Federal Reserve watches, they're only up slightly, and they're really the warning. If we get high wage increases, we might get inflation, but so far, mostly flat. The other thing the Fed is doing is selling off some of those bonds they bought up to stimulate the economy, but they're going to do that over 3 years, so that doesn't look like it's going to be much of a pressure on rates either. And the Fed is saying we're going to do 3 more rates, but they're also saying if the markets slow down or the economy slows down, we will not do 3 rate increases. So we think it's entirely possible you'll see only 2 more increases. And if that's the case, the stock market could move higher and bonds would be stable. The demographics are a deflationary factor, but even there you're seeing that seniors are really traveling a lot and driving airline uh, profits much higher. They're spending a lot on healthcare, as much as 50% of their monthly spending is on healthcare. So we're seeing a tiny bit of inflation in healthcare. Certainly the premiums for insurance are higher, but generally the demographics are still sort of deflationary for the overall market. Now, over time, over the next 10 years, as seniors get older and older, they're going to own less stocks, but that's down the road some. So it's a little mixed for demographics, but demographics are probably going to hold down inflation this year. Um, the one that's confusing for the marketplace and it is moving up and down is technology. Because on the one hand, technology is causing layoffs. You know, you don't see garage attendants because they've been replaced with a machine that processes your payment for parking. You don't see as many manufacturing workers. Plants that had 3,000 workers now have 300 workers. And soon we're going to see self-driving trucks and taxi drivers. That's a good paying middle class job that's going to go away. So that's all deflationary. But oh my, some of the new businesses, if you look at the growth in Amazon and online ordering, people ordering food from HelloFresh or Blue Apron, or ordering a taxi with Uber, or the whole new phenomenon of Bitcoin, this cryptocurrency online business, which is very complicated, but is a major growth area of the economy. Those are adding growth to the economy and adding new jobs we never even knew could exist. And one of the places we're seeing that a lot is small companies, because small companies are adding people and are adding profits because they are able to operate in a much more competitive way thanks to advanced technology. And one of the things coming very fast are these new intelligent semiconductor chips. That's going to create the whole self-driving car industry, and they're going to be explosive growers. So overall, technology is a plus for growth, and it makes growth much more profitable. How do we put all that together to figure out what's going to happen? Well, one thing is to consider proportionality. So here's a chart. The blue that you see in this chart, you see it peaking in the middle of the chart, 49. 49 represents a 49% increase in a single quarter. That's the first quarter, 2017, earnings, not revenue, not sales, but earnings for the semiconductor industry grew by 49%. How many businesses have you ever seen that can grow in a single quarter or a 3-month period can grow profits by 50%? Then they followed up in the second quarter of last year with 46%. Third quarter, again, an amazing 45% growth in profits. And even the fourth quarter, we saw very close to a 30% increase in profits again. We think that the current quarter that's going on now will probably produce something very similar. That's the forecast, about 27, 28% increase in profits for the semiconductor companies. That aqua line is all technology, including the cloud computers like Microsoft, and Amazon also operates cloud computing centers, or HP, any of those. You see that that's a very nice growth pattern as well. In the fourth quarter, that grew by over 14% in profits. Now, technology is about 25% of the market. So proportionally, when you see that kind of earnings growth in technology and semiconductors, it was so strong that even though the earnings of almost the rest of the market were basically flat, the overall stock market was up over 10% in just the fourth quarter. And look at the numbers last year. We made 13% in the first quarter, then 9%, 6%, and then ended up with 10%. So we had a year where, depending on your risk tolerance, your account was up, 15% to 20%, keeping pace with the overall stock market. We think that this force is going to continue. Even if it's below these kinds of numbers, the earnings are not going to decline in this fast-growing semiconductor and cloud computing area. So we look for this to continue to be a big positive driver for stocks in 2018. You said we really want to go to things in the market that confirm our fundamental view. And charts are a very objective way to do that. This chart shows the Semiconductor Index. And one of the things that it tells us is that we are now only at valuation levels that we saw way back in the year 2000. So it's taken about 18 years just to get back to this level. But unlike the year 2000, these profits are very real. They're not some forecast of a future phenomena. These are real, more than double-digit growth levels. So that's one thing the chart tells us. The other thing, for those that are technical observers of the market, is when you see a very long base building like this for years and years and years, it's very hard to slow that down. The whole semiconductor sector has an enormous amount of momentum, and that's one of the reasons we think this confirms that we will likely see a continuation of the increase in semiconductor prices. Technology, that index, which is 25% of the stock market, we see the same pattern. So if 25% of the stocks in the S&P 500 are technology, and they're going to grow profits 15 to 20%, we know that the S&P starts off on a pretty strong base earnings level. So we're pretty bullish for stocks with this chart. So one last chart. This is the NASDAQ 100, which shows up on your statements as QQQ. This is a holding that is in nearly every Affinity portfolio. It's the top 100 companies in the country, and you can see what an impressive chart this is. From a chartist point of view, you see that we see a pattern where the QQQ is making a new high, and then it sort of tests that new range, and then moves to another level, establishes a new high, tests that range. It builds multiple higher and higher channels, level after level. That's a sign of a very bullish stock. And so our holdings in the QQQ have been very successful, and a real reason why we're keeping pace or even beating the index in certain periods. But one of the arguments people say is, yeah, but it's pretty highly priced at this point. I think I'll wait till it pulls back. That little chart at the bottom there tells us when there's kind of an oversold pullback that you could use to get into the markets. But we've only seen that happen about every 7 to 10 months. We just saw one, but it was really as brief as a day. So waiting around to catch something that is just going to keep going higher can be a mistake. And certainly our decision to get into the QQQ has been one of our stronger decisions. But if we return to just straightforward fundamentals, the QQQ, here are just the top 25 holdings, which are about 50% of the capitalization, are really in those top 25 names. Look at this portfolio. Sometimes when we buy an ETF, we don't appreciate that we own these stocks. We own Apple, one of the top phone makers in the world. We own Amazon, a dominant retailer. We own Microsoft, that is really had the best success on the cloud. We own Facebook, and while Facebook is getting some contention right now, it actually over the last year or so is still, even after the controversy, one of the top performers that you could have held. Alphabet, of course, is Google, a tremendous dominant browser provider. Intel, the largest chip maker in the world. Cisco, which their equipment's in every cloud application. And a company like NVIDIA is playing in every part of artificial intelligence. It's just an amazing list of top quality companies you want to own in your portfolio. And I think that's going to continue as we go into 2018. So here's a juicy looking sector of cake. And the first thing we think about is, okay, semiconductor and cloud computing and technology are doing well. But what if we also see consumer discretion and financials, other large areas of the marketplace moving higher, unlike last year? Well, consumer sentiment has just hit a 17-year high above 100 on the index. When consumers who really drive 2/3 of the economy are that confident, they're likely to spend more money and drive the economy. And financials, if we see rates rising as we have been, And with the economy doing well, so very few loan defaults, financials can do better as well. They also have adjustable rate loans in most cases, so as rates rise, they get more revenue. So if we were to see those two sectors join in with technology, we could have a very robust year. But it's very nice to look at the market when you've got the wind at your back. The icing, which looks so delicious on this cake, makes me think of how nice it is that we have just passed an amazing 30% reduction in corporate taxes. That goes right to profits for most companies. So we're going to see the wind at our back. So those great double-digit earnings are now taxed 1/3 less. That has got to be a very strong plus for the market in 2018. Our forecast for 2018 is that we now have a better valuation for the market because of the 7 to 9% declines we've seen since late last year's peak. So we're getting stocks at a more reasonable price. So when I look to the right there and I see earnings are growing, here are the analyst forecast for earnings. That 16% actually has been revised up. It's about 17% growth rate we're expecting this year, 10% next year, 11% the year after. These are growth in earnings per share. If we see that kind of trend, there's every reason to believe that we can make more money in this market cycle. But let's turn our attention to another trip in the Wayback Machine. To what year? What year would this car appear? Well, in our session in Wilmington, somebody immediately, a car buff, knew that this is 1981. And 1981 is an important year for bonds because that represents 17% interest rate, the peak of interest rates, and they have been falling ever since. But we now have very low rates, and so for the next 20 to 30 years, we might well see gradually rising rates. That makes our challenge in bonds more substantial. As we stated, we don't see rates rising to 3.5% and 4%. They could ease themselves above 3%, but it wouldn't surprise us if they stay around 2.8% and even fall, which would surprise a lot of the experts. But you do see that our long-term trend is going to be up in interest rates, and if interest rates are going to rise gradually over time, we need new strategies, and we're testing those strategies in this year where we are seeing some increase in rates. So at Affinity, we've been employing a number of ideas to find yield and return without a lot of exposure to interest rates. As interest rates rise, remember, bonds tend to fall in value. So we want to reduce the vulnerability to rising interest rates, but find more yield to give you some return for bonds. So some of the ways we've addressed the bond challenge, one is bonds are simply not as good a deal. So we have slightly reduced everyone's bond portion of the portfolio. But we've also begun to use things like preferred stock. Preferred stock acts actually like a bond. Companies have to pay their preferred stock a yield before they can pay their normal dividend income. So we have a preferred ETF or preferred indexes in some of your portfolios. That produces about twice the rate of more common bonds, and it oftentimes is a more steady source of income and is not as interest rate sensitive as a pure government bond. We have also found that with the dollar falling because of the larger deficit, we're getting very nice currency effects that are helping us get very high yields out of emerging market debt. We've seen a recovery in the economies with a 5% worldwide growth rate. And that means that some of the countries that were struggling a couple of years ago have now gotten much stronger. and recovered, and so we can buy some of that debt and get a higher yield and benefit from a falling dollar. At Affinity, if you're qualified, if you can give up liquidity for 3 to 5 years, we have some clients in private investments. Those don't tend to be interest rate sensitive for the most part, and they really don't have a very high correlation to stocks. So that's a fairly sophisticated strategy that we can use in limited cases. Across our multi-sector bond funds that you see in your fixed income, there's a host of different strategies underneath those. Things like real estate income, but also corporate high yield. Since corporations have lower tax rates and higher earnings, they're in very good cash shape. So it's a time that we can take some risk on the corporate sector that they can pay off safely the higher yielding corporate bonds. And the other thing that we can do is keep our what we call the duration when our bonds are due by kind of laddering. A lot of the bonds that are held inside of all the things you own in fixed income will soon come to maturity. When bonds go to maturity, they go back to their original par value. Therefore, they're not very sensitive to interest rates. So that's another strategy we use to get return without interest rate risk. Another very positive move we've made across Affinity portfolios is to increase the holdings in international. One of the reasons for that is that we expected and we got a falling dollar. When the dollar falls, we get not only the gains from foreign investments, but they translate back into better results in the US. So when the dollar is weak, you want to have more international investments. So we saw that happening last year, and you can see that in all 4 of these indexes which you own, we're seeing very nice results because the valuations overseas are about 20% less than the US, and worldwide growth is estimated to be about 5%. So again, in 2018, one of the great strategies to stay diversified but increase returns is to keep international at higher levels, and that's where we're positioned right now. As we were trying to illustrate in the momentum ball model, day to day, these what we call kind of macro events, whether it's the British leaving the common market or increased tariffs, don't tend to be long-term drivers. They certainly can affect prices dramatically for a day or so, but we really don't see much sustained impact on markets for some of these scary headlines that we see on the news every day. And the latest one is really tariffs. We had Trump put tariffs on steel and aluminum, and then on about $60 billion worth of sales with China. But he didn't actually implement the tariffs when they were announced. And since announcing the steel and aluminum, he's actually negotiated Korea and Canada and Mexico, the countries we really do actually buy steel from, have actually been given an exemption. So the impact of what looked like a scary tariff is actually much smaller. The same thing is happening with China. In China's case, we announced tariffs and said, oh, but by the way, we're willing to negotiate. So they announced a response to that and said, oh, really? Well, we'll put something on agriculture. We'll put tariffs on agriculture and some of your semiconductors and all the rest, but we're not going to implement them yet until we get a chance to negotiate. And so both sides are actually busy negotiating. In the end, it's our belief that this is still a fairly small event. If it spreads, it certainly could be material, but for the next few months with what's been announced, even if it wasn't negotiated down that much, there's really not a major impact on a $19 trillion economy from the tariffs that have been announced. I look, for example, everyone's very worried about soybeans and all the agriculture that the Chinese might put tariffs on. But when I took that into the final impact on profits, it looked like $1 billion. Again, $1 billion impact in a $19 trillion economy. We just don't think tariffs will end up being as big a long-term issue as they sound when you watch the news every day. One of the strong traditions at Affinity is to always ask ourselves, what if we are wrong about these observations? And if that happens, what that means is rates will skyrocket to 3.5% or more for the 10-year. We'll see inflation also moving toward 3%. Consumer confidence will fall, and there'll be layoffs, and wages will, after maybe rising in the short term, will then decline. International growth, which is really picking up, will immediately slow down. And if that happens, one interesting observation is we could see the same kind of growth companies that we own actually still doing well for a different reason. That is, when the market gets scared about whether there's going to be growth, they tend to even put a bigger premium on the fast growing part of the market. So our belief is you actually might see people buying a more focused group of growth companies like we hold as a defensive measure because they don't trust the other parts of the market. So we do have those positions that will benefit if we see some of the things happen that we don't expect. The other thing, of course, is if inflation really gets rising, we actually might see that you may get pricing power, and some of the sectors that we own may actually be able to raise prices and turn in even better earnings. So we really think that at this point, the price charts for the defensive part of the market, like utilities and staples, are not showing any signs of this happening. And that's one of the things we would see. So if we saw utilities and staples moving up steadily, we would reevaluate and adjust the portfolios. I hope you've enjoyed the trip in the Wayback Machine. I always enjoy updating our clients about our opinions on the markets. I really, if you have not had the opportunity to attend our Wilmington sessions, we get very strong feedback on those. I think you would enjoy that, along with some good visiting time and great food. So please come out and join us at the next one. And I want to end by thanking you for your loyalty and confidence in Affinity. We'll do everything we can to earn that going forward.